Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Akamai Technologies Inc. Annual Report. Akamai Technologies offers a wide range of businesses and services that cater to various needs of its customers. The company's security solutions include web application protection, API protection, bot and abuse portfolio, Akamai Account Protector, and Akamai Content Protector. These solutions help protect against threats such as account takeover, credential stuffing, inventory scalping, and hoarding. In addition to security solutions, Akamai provides cloud computing services that include compute, storage, networking, database, and container management services. The company's cloud platform also offers ready-to-run templates for deploying, managing, and scaling Kubernetes clusters at scale through its Akamai App Platform. Akamai's delivery solutions enable dynamic websites and applications with web and mobile performance solutions. These solutions include global traffic management, site acceleration, application load balancing, large-scale load testing, and real user monitoring. The company also offers media delivery solutions that include video streaming and video player services, game and software delivery, broadcast operations, authoritative domain name system resolution, and data and analytics. Furthermore, Akamai has technical alliances with Tollbit and Skyfair to enable publishers and content owners to monetize AI bot traffic. Overall, Akamai Technologies provides a comprehensive suite of businesses and services that cater to the needs of its customers in security, cloud computing, and delivery solutions. Akamai Technologies Inc.'s stock price has experienced a significant surge over the past year, with a 22.62% increase and a trading range of $67.51 to $113.50. A notable period of growth occurred in mid-February 2026, where the stock price rose by 10.35% on February 12 and an additional 6.83% on February 13, resulting in a total increase of 17.89%. This sharp rise is likely attributed to positive investor sentiment leading up to the company's fourth quarter and full year 2025 financial results. The company's strong performance was bolstered by robust demand in its security and cloud computing segments, with notable growth in revenue and adjusted earnings estimates. Specifically, Akamai reported an 11% increase in security revenue and a 14% growth in cloud computing, with cloud infrastructure services revenue jumping 36% year-over-year in Q4 2025. Despite concerns over higher capital expenditures for AI infrastructure and memory shortages impacting the 2026 profit outlook, the initial positive reaction to the earnings announcement contributed to the overall increase in the stock price during the past year. Akamai Technologies, Inc. market capitalization of $14 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Akamai Technologies, Inc. holds a significant advantage in their industry. Akamai Technologies, Inc. trades at a higher price-to-earnings ratio of 28 times and a higher price-to-book ratio of 2.74 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the demand for security solutions has been on the rise, with an increase of 9.8% from 2023 to 2024 and 10.9% from 2024 to 2025. This is followed by the growth in cloud computing, which saw a significant jump of 28.2% from 2023 to 2024 and 25.1% from 2024 to 2025. Additionally, international revenue has also been increasing, with a rise of 8% from 2023 to 2024 and 7.5% from 2024 to 2025. On the other hand, there are several drivers that can lead to a decline in revenue. One major factor is foreign currency risk, where a strengthening US dollar negatively impacts revenue and expenses. Furthermore, increased provisions for doubtful accounts have also been indicated by an increase in allowances for current expected credit losses and other reserves. These factors highlight the importance of managing foreign exchange risks and maintaining healthy financial relationships with customers. In terms of specific transactions, the company has made several acquisitions, including Edgio, Non-Aim Security, and Fermion, which are expected to contribute positively to revenue growth. However, there have also been some negative trends, such as a decrease in deferred revenue by $444,000 from 2024 to 2025, and an increase in operating lease liabilities by $88,214,000 from 2024 to 2025. Overall, these factors demonstrate the complexities involved in managing revenue growth and decline for a company. The net income of a company underwent significant changes between 2023 and 2025. Initially, it decreased by $52,887,000, 9.6%, from 2023 to 2024, followed by another decrease of the same amount, 10.5%, from 2024 to 2025. This downward trend in net income is mirrored in the profit margins, which dropped from 14.38% in 2023 to 12.65% in 2024, and further declined to 10.8% in 2025. The reasons behind these changes can be inferred from various factors. One contributing factor was the increased costs associated with mitigating cybersecurity threats and vulnerabilities. Additionally, reduced revenue growth due to competition and market pressures also played a role. The decrease in traffic on the network and higher interest expenses further exacerbated the decline in net income and profit margins. Furthermore, the provision for income taxes also decreased, leading to a lower net income margin. These factors collectively contributed to the downward trend in net income and profit margins over the 3-year period. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, the company has consistently produced significant amounts of net cash from operating activities over the past 3 years. In 2025, the company generated $1,518,765,000 in net cash from operating activities, while in 2024 it was slightly higher at $1,519,171,000. The previous year, 2023, saw a notable increase to $1,348,439,000. These figures demonstrate a clear trend of positive operating cash flow, indicating that the company is effectively managing its finances and generating sufficient funds from its core operations. This achievement is a significant indicator of the company's financial health and stability, allowing it to invest in growth initiatives, pay off debts, and reward shareholders through dividends or share buybacks. Overall, the company's ability to consistently generate positive operating cash flow positions it for long-term success and resilience in an ever-changing business landscape. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt, the convertible senior notes outstanding have remained relatively stable at $4,140 million as of 2025, with maturity dates ranging from 2027 to 2033. However, the total obligation under operating leases has increased significantly due to additional operating leases executed in 2026. In contrast, interest expenses have seen a notable increase. From 2024 to 2025, interest expenses rose by 13% and $3,642,000, respectively. Furthermore, when comparing 2023 to 2025, the data indicates a substantial increase in interest expenses over this period. These changes suggest that the company's debt level has not significantly changed, but its interest expenses have increased substantially. The performance of various segments and regions has been impacted by several factors. In terms of poor performance, Israel stands out as a region that has been affected by hostilities, leading to issues with employee availability and business operations. Additionally, high-risk countries have also struggled due to concerns over the theft of intellectual property. Furthermore, there are regions that pose potential risks for future harm or disruptions. These include areas with historical or ongoing political instability, warfare, or terrorism. Such conditions can create an environment where businesses may face significant challenges in maintaining stability and continuity. Management is optimistic about the company's future prospects despite facing challenges in various areas. The company's diversified customer base and ongoing credit evaluations are expected to mitigate risk. Financial results will be impacted by fluctuations in foreign currency exchange rates, but management is focused on making strategic investments to strengthen the business. In terms of strategy, the company plans to offset dilution created by employee equity compensation programs through share repurchases. It also aims to integrate acquired technology onto its platform and redeploy resources to support strategic investments. The company has committed to restructuring certain parts of the organization to align with long-term growth priorities, including headcount reductions and impairments of assets. Management's outlook suggests that the company is well-positioned for future growth, driven by its ability to make subjective estimates and judgments about uncertain matters. The company's financial stability and flexibility will enable it to continue making investments at opportune times. Overall, management's strategy is focused on driving long-term growth and strengthening the business through strategic investments and restructuring efforts. Acquisitions and divestitures are significant business strategies that companies employ to expand their operations or shed non-core assets. In recent times, Akamai has been actively involved in both these activities. The acquisitions made by Akamai include the integration of Linode's compute platform into its own platform. This move is expected to enhance Akamai's capabilities and provide a more comprehensive service to its customers. Additionally, the company acquired Fermion in November 2025, certain customer contracts from Edgio, Inc., Non-Aim Security, Lumen Technologies Inc., StackPath, LLC, Neosec, and StorageOS Inc. On the other hand, Akamai has also made divestitures to streamline its operations. One notable example is the assumption of operation by a U.S.-based joint venture of a U.S. application previously owned by a Chinese company on January 22, 2026. This move indicates that Akamai is focusing on core areas and shedding non-core assets to improve efficiency and profitability. The company's financial strategy reveals a mix of dividend and share buyback policies. While it has not paid any cash dividends to its shareholders, it has instead retained earnings from operations. However, the company has been actively buying back shares, with a total of 22,454 shares repurchased at an expenditure of $2.01 billion. This indicates that the company is prioritizing share buybacks over dividend payments, suggesting a focus on returning value to its shareholders through other means. The current situation raises significant concerns about the stability and resilience of supply chains. One major concern is the potential for disruptions to critical infrastructure, including workforce, networks, financial systems, and other essential services. This could have a ripple effect on revenue from security solutions due to reduced traffic levels on their network. Furthermore, large competitors are exerting significant purchasing power, giving them priority access to servers, memory, colocation capacity, and power. This creates an uneven playing field, making it challenging for others to compete. Additionally, accessing transmission capacity and colocation facilities is becoming increasingly difficult due to resource limitations, rising energy costs, or other external factors. The uncertainty surrounding energy supplies adds another layer of complexity to the situation. Disruptions in supply chains are also a concern, as they can prevent companies from purchasing necessary equipment at competitive prices or even at all. These challenges highlight the need for robust contingency planning and strategies to mitigate potential disruptions and ensure business continuity. That concludes the financial summary for Akamai Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.